Yeah, so Adam or Preetu, any reaction to some of what Dom had to offer?
Oh, thank you. I completely agree, and thank you for being being so kind and saying we justify your existence, but surely your work is more important. We just connect the dots backwards.
Well, as we prepare to open it up to broader Q&A, I have a question for you, Dom. So a lot of the research today and your discussion here is emphasizing the point that the conduit matters. Okay, so you were talking about maybe there needs to be some subsidy or some capital that needs to be brought, but actually it matters that it comes through the minority depository institutions. And one thing that I was thinking about as sort of an alternative thing that you didn't bring up is, what about employees? So to the extent that relationship and culture matters, where do you see, bringing in employees of color and what have you in this whole scheme?
Yeah, I think, well, it is relationships. I would say they start with that, the frontline bankers. But I would say more than just the employees, it's where they are located and how accessible they are. So I do think connecting particularly, so if we want to serve an underserved community and do it intentionally, I think we've seen the studies. Even the FDIC had a study a few years back that showed actually there's a proximity issue, and it was both research papers pointed out there's a geographic alignment or geographic benefit for closing the gap, right? So if you have a branch in a particular community, you're more likely to originate more loans. So I think you're right. It's the employees, but it's more important also where they are located, right? And we're starting to figure that out. So one myth that I do want to, I was propagating this myth, so I'll admit how uninformed or misinformed I was. But this belief that financial technology can increase access to just by itself in delivering that conduit and delivering capital and opportunities to underserved places. I believe that for even for some of the older borrowers who are maybe not as comfortable with that, you could overcome some of the barriers. And certainly during the pandemic, we made strides. But I can tell you, those fingerprints on my window that are still there when they were banging on and trying to get in and have a conversation with someone prove that it's that the technology should be used to bring us closer to that relationship, not replace it. And so we have at our bank, we have a belief that everyone that walks through our physical virtual door needs to leave better off than they walked in, whether they walk in physically or virtually. And one way that we make sure that we use technology to remove the friction from that interaction. So I call them dumb transactions, right? So I say, please stop doing dumb transaction, focus on value-added transaction, how you can actually improve the customer's financial well-being versus just cashing their check and sending them on their way. And I think that's the value of the proximity and the geography.
Very good. So I see a question in the chat here from Sam Rosen that asks, how does the lending that CDFIs do compare or interact with SBA lending?
Very, very good question. The answer is there is a significant level of alignment, but ultimately CDFIs are focused on underserved communities and underserved people. And the SBA programs, especially the 7A and 504, it's closing some of those gaps in those places. So you will see a lot of CDFIs, including ourselves, are actually deploying that's SBA tool to close the gaps, because we are banking in the gaps. We're banking in more of the gaps that exist. So we need some credit enhancement. So there's a perfect alignment. But the difference, I would say, it's not necessarily different lending. It's all lending focused on closing some market imperfections. But for the SBA loans or the SBA enhancement, there's a lot of deals in America wouldn't be done. A lot of credit wouldn't flow because of that little bit of enhancement that's needed to close the gap for the lender.
All right, well, let me just remind folks that you can either raise your hand in the participant panel or type in a question to us. I did have one that came in the background to me, and I think it's directed both to you, Dom, and to the researchers. The question was, based on the findings of your research, are there any policy recommendations you would make to help drive some improvement in this area?
So let me just say a few things on that. I mentioned briefly towards the end of my presentation is that in my reading of the section 308 of the FIRIA, which is where all the MDI stuff is defined, the goal of preserving MDI status, even in non-assisted voluntary mergers, should be pursued not on a best effort basis, but rather a more laser-focused basis. So, I mean, FDIC does make sure that in assisted mergers, failures, the new bank is still MDI, but even in voluntary mergers, I'm saying MDI status is something important, as Dom has been saying, and which is pretty much the point of my paper, is if you lose the MDI status, then a lot of other relationships get lost. And the second thing, which is a much broader thing, I guess, perhaps very big thing, is that we've had 45 years of income targeting, right? Targeting relative family incomes against the MSA income, right? And the underlying principle being you target income, you automatically take care of groups. I think day before yesterday, there was also a question to the chairman. I think there is some merit to doing, even with CDFIs, right? We are defining areas more or less based on what is the percentage of MFI that they have relative to the, the MSA. Maybe some kind of group targeting or MDI benefit would also help in that sense. This is my second thing.
If I can add quickly just a couple other policy interventions that are relevant to this group. I think clearly we're facing a CRA reform, and
Yes.
I think the CRA is critically important to our communities and to mission-driven lenders and banks. So I think that's one. Two, I mentioned the CDFI fund. I mean, that's been a massive really help, but the funding has been hovering around 250, 280, 300 million. It jumped temporarily with the COVID relief funds, but just imagine the leverage of funding in our communities if that funding was increased to it. That's the other thing. I do think that the regulators have been incredibly helpful, and we do receive technical assistance and support for our minority banks. But I think that there could also be several other policy interventions that could be made by the agencies, by the Federal Reserve and the FDIC and others to really support the mission-driven lenders a little bit more in underserved communities because of the costs and of the difficulties that I pointed out. So I think there's tax policy, there's of course fiscal policy that could be implemented, and there's regulatory policy that could also be a huge help and a lever.
We do. Let me jump to a question in the audience. So Mary Zaki, I believe it's pronounced. Mary, you can come off mute and ask your question. I think this will be the last question we have time for, unfortunately, before we need to move back over to the main room. So Mary.
Thanks. This question is for Adam. How come previous literature didn't find a relationship between the market concentration and, let's say, the credit pricing? Why do you think you are finding a different result?
That's a great question. I wish I could say it's because I'm much smarter than the previous literature. Unfortunately, that's not the answer. The answer is that previously only data on interest rates were available. So a lot of the previous studies have looked at the relationship between local concentration and interest rates. But recently in 2008, the CFPB made available data on non-interest fees, costs as well. And that's where we find the largest differences. So the short answer is because more data became available. So maybe that the point is that if we want to help, especially underserved communities, we need to have a laser focused on it and generate more data and generate more awareness.